So I want to talk to you about an income statement today. Yeah, it's an important statement for a small business owner to be looking at. And the other day I went over briefly what all the financial statements were. So today we're going to do a little bit deeper dive into an income statement. An income statement is a statement. It is your income and expenses. It's your revenue and expenses over a given period of time. So that time can be a day, it could be an hour, it could be a month, 3 months, a quarter. It's never longer than a year, but it gives you a period of time. It's a periodic statement. And what this statement is telling you is not how much cash you've made, how much cash you've brought in, but how much revenue you've generated and what resources it took to be able to generate that revenue, which is the expenses. So if you make a sale, if you're on the phone with somebody and you're like, hey, you're looking for widgets, I can definitely provide you widgets. And they're like, great, I'll buy 10 widgets. And you're like, cool. So you send them an invoice for like, I don't know, $500. That's revenue. That's not necessarily cash though. So you have the invoice, they haven't paid you yet, but you have this revenue amount. But then you're like, oh man, now I gotta make these widgets. So now you gotta like pay the wood guy, and you gotta pay the administrator who's helping you administrate things, get organized, and you've got to pay the guy that sends you the packaging for your widgets and all this stuff. So you've got to spend money in order to produce the widgets and the packaging and everything you need to be able to fulfill the sale that you made. So those expenses represent the resources it took to generate that sale. What does this mean? So what this means is it tells you the relationship that each sale has to the amount it costs to produce it. So some costs are variable costs, which mean that for every unit that's sold, it directly relates to that unit. So for widgets, if you had a metal widget, then the metal that you made the widget out of would be a variable cost, right? Because every time you make a widget, you need metal. It's directly related costs like that. It goes up in the same linear fashion. And then there are fixed costs. So fixed costs are things like rent. Rent is the same amount whether you sell one widget or a million widgets. Theoretically, I mean, if you had, you needed more widget making space because you're making, I'm getting off topic. Rent theoretically is the same. Internet is similar to your internet bill, costs the same whether you make 100 widgets or a million widgets. So those kinds of things, they are not directly related to the amount of sales that you make, are fixed costs. And then we have this nice little hybrid, which are called step costs. So step costs are things like gas or electricity, where like you're the same price for a little while, and then you reach like, I don't know what it is, like 1,000 megakilo wattageness. That's definitely it. And then your price goes up to the next tier kind of thing. And so those, while not directly related like one for one to the units that you're selling, they are semi-related in that, if you were making 100 widgets, you might be like this level, but if you're making a million widgets, then maybe it's like this tier, steps. Does that make sense? That makes sense. So you have variable costs, you've got fixed costs, you've got step costs, and all of these relate to what it takes to generate a sale. And so it's really, really important when you're looking at your income statement to understand like, oh, okay, I spent this much on my phone bill. Is that related to my income? And I think that the most important piece of that is when you generate new sales, are you actually making more money? Because if you were to double your sales tomorrow, it might be that you can't you don't have enough cash to be able to create all the widgets that you need to actually fulfill those orders before you get paid. So you could be in a serious cash flow situation, even though it looks like you have a huge amount of revenue. Well, you would have an amount of revenue. So your income statement, it's showing you one piece of your business, and it's really a lot closer to the day-to-day than the balance sheet that we talked about, or the the equity piece, which is part of the balance sheet, but I mean like statement of shareholders equity. Those are important to look at, but they're not the day-to-day stuff. So I would be looking at my income statement at least once a month. It depends how often you're doing your bookkeeping. If you're doing your bookkeeping once a month, then I would do it once a month. If it's once a week, probably once a week is a good idea to just keep an eye on what's going on. I would never want to see longer than, say, 3 months, because then you're starting to look at too far behind you, and then it's reactionary, right? So our financial information is really only as important as it is timely and accurate, obviously. But if you're looking at last year's income statement, that's not going to help you make decisions for this year. Did I answer all the questions that I left in my description there? I think the income statement is definitely the most popular one for small business owners, but I do think it's important to understand that just because your sales have gone up, or just because your expenses have gone up, that one number doesn't necessarily mean anything on its own, and that when we're looking at statements like these, it's important to have multiple years or multiple periods, so we can start to do some trending and see like, oh, the revenue went up this month, but if we look at this month last year, it did the same thing. So that was seasonal, and we can say that we expected that increase in revenue. But if we're looking at 12 months or so, and we can kind of see a gradual up curve, then that's probably a real growth in sales, rather than having the seasonal sales. If you're looking at this month last year versus this month versus last year. Does that make sense? Comparing this month to the same month last year, or comparing this month to last month, you're going to get different results. So in conclusion, I think your income statement is something that you should be looking at, but make sure that you're looking at it over the course of a few periods, and that you're looking at the relationship between the income and expenses, and not just looking at one number, because one number can be misleading. If you'd like more information on your income statement or the other statements in your financial statement package, I go into ratios and stuff like that in this. Oh, sign up for the 5-day video series. It's free, and it's videos of me talking about financial statements. And I've also written a little article for each of them in case you prefer to read rather than watch. And I go into ratios and how to actually calculate some of the percentages that are really interesting and really important. It is not hard. I promise you, I'm not giving you calculus to do. It's really easy to do, and I will walk you through that step by step in that course. So sign up there, and you'll get 5 little bite-sized chunks over the next 5 days, and you can learn to decode the hidden messages of your financial statements, which is just I love that stuff. So join me. You can love it too. I'll see you tomorrow.